What do you think really drives this? Is it the concern? I mean, I heard that there was one report, Global Times of China, which actually said there was a sharp increase in the coronavirus because they had started to recount it in a different way, which made it look better. I don't know.
Patient counts in a Beijing hospital or something. I probably saw the same Twitter from the same person. Right. But I struggle to think that this is all about the coronavirus. To be sure, it's a risk-off event, and when you think about that dichotomy between the performance of the Treasury market and the equity market, typically people will tell you, oh, well, the bond market's telling you that this is a bigger problem.
Right.
I think that's fair, but it's a bigger problem in the rest of the world than it is in the U.S. This has been a consistent theme. I'm of the opinion that we're in a long-term deglobalization trend. And so if you think about economies ranked 2, 3, and 4 relative to the U.S., China, Germany, Japan, or Japan, Germany, they are very export dependent. So coronavirus-related supply chain disruptions is a much bigger problem for Germany selling capital goods into China, Japanese selling autos and the like. And that's been driving the flight to safety. The U.S. has become the dominant source of global safe assets since the financial crisis. That's accelerated. So the fact that the dollar's had this big move and the Treasury market won't even respond to a number as strong as the Philly Fed survey, which indicates capital spending's coming back in the U.S. We've got an inventory restocking that's begun in the U.S., and you get no movement out of the bond market whatsoever. Remember, the time frame for where we fell this morning was 11 to 11:30.
Right.
That's right into the European close.
Yes, that's exactly. Right? I thought the same thing.
We've had that pattern where we get really weak into the European close. And again, the coronavirus is a much bigger deal for Europe than it is for the U.S.
And that's been I've watched that pattern over 20 years. Everybody always noted, oh, that's the European close.
Right.
You had to wait till the end of the day to really see what.
Right. So I think that's all a dynamic. But for me, if we step back and we do bigger picture, like you intimated I was going to try and provide.
Yes.
My forecast for this year was that the market would be strong until round about April or May. And the idea was we're going to get a recovery in capital spending plans in manufacturing in the U.S. in particular because of the resolution of the trade wars.
Right.
We were going to get a real boom from Fed liquidity, and we would have a still strong U.S. consumer, though the data on that hasn't been great recently. Overall, it's still the case. But then we'd get to April or May, and the Fed would start withdrawing that liquidity. They'd start reducing the $60 billion per month of Treasury bill purchases. Every business cycle since World War II has had one Fed-related, call it monetary policy normalization-related correction. This one's had 8. I think that'll be 9, right? And so if you think about the last 24 hours, the Fed minutes came out. They talked a lot about financial instability and how there was almost an admission in those minutes that several FOMC participants are concerned that the balance sheet expansion isn't free, as Rob Kaplan from Dallas Fed put it. And then today, Clarida sounded pretty upbeat about capital spending and, sort of detailed, they're going to cut the bill purchases. So that may be the overriding instability, and behind is the market's recognition that liquidity dynamic in the U.S. has only got a couple of more months to go.
And it may mean that the Fed was going to stay more steady rather than this potential cut.
Yeah, so what I've written about most recently is inflation picking up. Now, my long-term call is that inflation will remain quiescent, but in the short term, you've seen housing-related costs going up. Medical costs in the CPI series are running at 5%. You would expect import prices to start going up as the trade war gets settled. PPI was off the charts the other day. CPI was stronger than expected last week.
So you sound more optimistic than pessimistic. I mean, you're talking about CapEx spending. You're talking about, a lot of great things that are going on.
Absolutely. But when that happens and then the Fed decides to step back and they don't validate this market pricing of further rate cuts, right? And the Fed says, no, there is no rate cuts. The data is strong, and you lose that incentive. Then that causes an uncertainty shock, right? That's what these normalization-related corrections are.
And you put that coupled with the uncertainty of what really happens with earnings on the heels of the coronavirus. Because
I still have earnings.
know 100% how the coronavirus will affect
Correct. Although for me, it looks like earnings estimates are still rising in the key sectors, right? So software in particular. My bottoms-up S&P 500 CapEx numbers are moving up, not down, even faster than I thought they would recover. R&D spending in the tech sector is running at 16%. So I think that underlying fundamental story is okay, but it might just be a little too good for all the people that were counting on a lot of Fed liquidity to drive returns through the course of the year.
Right. What about the small businesses? You've talked a lot about the Fed and the consumer and coronavirus. What about the small businesses?
Well,
you've been watching that as well.
That survey at the beginning of last week, the NFIB, easy for me to say, small business survey was actually quite robust. And so I would suspect that in a lot of ways, the market thought, well, a trade war is much worse for big companies relative to small. But that's actually the opposite. When you talk to small businesses that source anything in China, they don't have alternatives like Walmart does, right? So I think that the settling of that is really good news for small businesses.
I think we have to, sort of put it forward as something actionable now. We have some volatility in the market, which is fine, right? Do you buy the dips? Do you buy a certain sector on the dips? What should people do here?
Yeah, so for me, between now and that April-May timeframe, so this is getting a little tactical. This was my call for the beginning of the year. 5 months is now consolidating into a couple of months. I still like financials, tech, and industrials, the software part of tech in particular, even though they're expensive, and on a day like today where you get a risk-off event, they get hit hard.
Right.
I think in that April-May correction, we're going to get a window of opportunity to buy energy and healthcare. And that's going to coincide with the political cycle, because even if the Democrats nominate one of the more moderates, it's still going to be fracking for no one and Medicare for everyone or some form of that.
Right.
So those two sectors I like longer term for different reasons. Healthcare, because I see technology adoption and innovation adoption finally coming in. Margins have started to improve after a 30-year decline in healthcare margins. So they could become more productive. That's the call there. And on energy, just think about what happened to crude through this whole crisis. It dropped to 50 and stabilized because of the expectation that U.S. production growth may slow, right? So fracking has fundamentally changed the elasticity of supply on the upside and downside.
Right.
So what I'm expecting over time, and if you look at the standard deviation of CPI gasoline prices, it looks like it did in the 50s or 60s, a much more stable price. So if you think about investing in energy companies, if the boom-bust parts of the cycle are gone because fracking can either ramp up or slow down, then you have more stable prices. And at some point, they begin to act like the financial sector over the last couple of years, where people realize, hey, okay, there's not the big upside anymore, but there's not the big downside either, a more stable stream of cash flow, and then you ought to buy the sector. So I'm thinking political uncertainty will create an even better opportunity for that sector. Round about April, May is sort of my time frame.